The concept of moving average trading strategy has been misused by various traders due to inability to understand how to apply the moving average in terms of their trading. Some believes that when the moving average with the lesser period crosses the one with a high period, it is an entry or an exit signal. But however, this may seem to be true, but there is a wrong way of interpreting and applying the moving average. Just because the moving average crosses each other is not enough to validate an entry. And just because price is below a certain moving average is not enough to guarantee the trend of the market. So in this video, I'll be showing you the right way that you can apply your moving average and profit from it. So on my chart, I have the following moving average. I have moving average 200. The shift is 0. The method is exponential. You apply it to close. The next moving average is moving average. The period is 25. Shift is 0. Method is exponential. You apply it to close. I have the third moving average. The period is 10. Shift is 0. Method is exponential. You apply it to close. Then afterward, we have our relative strength index. The period is 9. You apply to close. Here are the levels: 90, 80, 50, 10, and 20 respectively. Then afterwards, you take note of this particular point. Let this color be the background of your chart. My chart is white background, so the color is white. If yours is black, please kindly change it to black. Then we have our commodity channel index. It is the default commodity channel index setup. And if you have done your setting correctly, your chart will be looking exactly like mine. Now, what are the use of this moving average? The EMA 200, which is this black moving average line you are seeing, is used to determine the trend of the market. Remember, the trend is always your friend. So any trade you will make should be in the direction of the trend. But however, this did not guarantee 100% trade probability in your favor, because market will never work in your favor all the time. But this has an advantage because it has a high probability winning rate. Then the moving average 25, which is the blue line, and the 10, which is the red line, is for your entry confirmation and validation. Then coming to our indicator window, the commodity channel index that you are seeing is only for two purposes. One, for determining divergence at your point of entry. And then secondly, to check the level where price has gone to relative to your indicator window. But this is the disclaimer. We are not using the commodity channel index to identify overbought or oversold. So please take note of that. Now, let's go into our application. Now, when price is above the moving average, you can see that price has been above the 200 exponential moving average, which is this black line. Price is in an uptrend. So you can see it, the price is in an uptrend. Now, when price is in an uptrend like this, and then suddenly price crosses the middle Bollinger Band, such as you are seeing here now, we now conclude that we are in a downtrend. So, immediately price cross this moving average, and it is now to the downside. it is not enough to conclude that it is a downtrend. What will make it a downtrend? It will become a downtrend. We will want to see this price that has crossed down to pull back to this moving average and then retest it. When we get that retest and price is being rejected and price becomes consistent under the moving average 200, that is when we now conclude that we are in a downtrend. Then secondly, I want you to take note of this. You can see that here price come down, went up again and closed above it. Now, this moving average is being treated as a zone. You must take note of that. You don't consider only the line. So you consider a perimeter for this moving average. So all of this zone is the zone of the middle Bollinger Band. So even if price did not touch it, for instance, price return from this upside, reject from this zone and continue, it is considered to have retested the moving average. So that's just the implication of that. And I want you to take note of that. So you can see now that price went and then retest this moving average, and that validates that we are in a downtrend. So this second retest that you had here is a confirmation that we are now in a downtrend. So now let us look for our entry confirmation. Now if we must sell, remember this is not the first, this is the first retest, price came down, so price has proven to us that is now consistent, it's a downtrend. Then price went again and then came down, right? Now we know that we are in a downtrend, and here is our first trade entry. So pay attention, how now do we sell? When price is around this zone of the moving average, we will need a price action. What price action? We need a candlestick pattern. I will be looking at only two types of candlestick pattern. Either bullish engulfing, depending on the trend. When it is a buy trend, bullish engulfing and bullish pin bar. When it is a downtrend, we are using a bearish engulfing and a bearish pin bar. So once that is identified and it is established, we will now walk into it this way. Price will now pull back. When price pull back, we want to see price get rejected from this EMA 200, which is the black moving average, with that candlestick pattern. So as you can see here, this is the first rejection candle, this is the second rejection candle. So now we have that particular confirmation. And if you are good in trading chart pattern, you will realize that this chart pattern is as well a bearish flag pattern, which I'll be discussing more in the subsequent video. So we have this chart pattern down there, and then what happened? Price closes outside of it. So when this price closes below the moving average, you make your entry. That below moving average, either 25 or 10, any of them, you have your sell, your stop loss is here. And you can see how that will play out beautifully well. Now, what is the consideration of our indicator window? This indicator window now, you can see that this indicator window is not at the level of 80 or 90. Is somewhere is coming from the upside. So because it's coming from the upside, we see that there is still more room for price to go down. So we make our entry, even though we don't have a divergence in this particular scenario. So after that particular one, here again is another of our entry. Look at this. Price pulled back again and gave us this beautiful entry. After that rejection, you can see that candle close. So this is our entry, and then here is our stop loss. And you can see how price plays out. So you will wait again to get another pullback to the zone. And as you can see, this is another pullback all the way to that zone. Do you get that? Now, you can see that this particular one did not touch the indicator. This pullback did not touch the EMA 200. So it is not mandatory that it touches the 200 EMA. That's why I say we are treating this area as a zone. When you pull close to it, be patient enough for it to pull back and then closes below this other moving average. So you see that? So this could have been your sell entry. Your stop loss is above that, and you can see how that plays out. Now, in this condition, this particular one that happens here, we are having a divergence. Now, what is a divergence? I'm going to do a special video on divergence for this particular channel so that we can understand what exactly divergence is all about. But in a nutshell, it is a disagreement between the price action on the main chart and that of the indicator window. So you can see that here price is giving us higher high, but the indicator window is giving us contrary to what we are having on our main chart. The indicator window is making a lower high. So that is the difference. And because of that disagreement, we have that particular entry. Now, watch out for this. So now that we are in a downtrend, when the trend becomes very strong, price will not be able to pull back to the 200 EMA. Very important. When the force of the market becomes very strong, price will not be able to pull back to 200 EMA. Then price begin to respect only the 25 and the 10 moving average, such as in this particular scenario. You can see that price pull back only to this zone, give us candlestick pattern, and then from here we are in that sell to the downside. Now let me give you an instance. Look at this particular instance. This is very much crucial. Like in this scenario, look at it. Price pull back into this moving average here, but look at our indicator window. Our indicator window is almost at the level of 20. So because this indicator window is at the level of 20, and price, even though price pull back to this moving average, we will not be taking that trade. Because looking at this, we may begin to get a divergence for price reversal because price is almost, there is no much room for price to go down. And that is why we are not taking that. But look at this one, this particular scenario. We have this entry here to sell, and this is coming from 50. So this is a good one. So we'll have this sell all the way to this downside. So please take note of that. And then now, price has pulled back. Beautiful scenario. Beautiful scenario. Just watch out for this, please. Look at now. Price pull all the way back to our moving average. So you can see, if price get rejection, please take note. If price get rejection from the moving average and price went above the moving average 25 and 10, you can still have your sell entry because the trend determinant is the EMA 200. So from here, we still have our entry. So we can sell here, and then you see how it plays out all the way to this point. Then afterwards, look at this one now. Price now at this time pull back to our moving average. So price did what? Price went above it. Do we now conclude that we are in an uptrend? The answer is no. We want to see price retest this our moving average 200, let it be rejected to the upside. When it's coming to retest it again, we will now find our entry to buy to the upside. So that is what we will want to do. Otherwise, we will see this as a pullback because price can decide to come down, go back again, and continue to the downside. But however, Now price is here. Even if this price closes below this moving averages, I will not be able to sell. Get that point? Even if price closes below this moving average, I won't be able to sell. Why? Because looking at my CCI is at the level of 10 and 20. So I will only be selling when subsequently I will only be selling because price is already here. So I can't sell because this is here. So I will only sell when price pull back from here either to 50 or to around 80 and it's about coming down, and then maybe then I'll have another pullback to the moving average and then I will be able to sell. So this is how perfect you can apply this moving average strategy. I believe you have learned something new. Please do not forget to give this video a like, share, subscribe, turn on your notification bell so you'll be the first to get notified when we upload another video. Thank you and see you in the subsequent video.